So since today is a day one of a part two, I'll just go through what all topics and how we are going to proceed for further. So today we will be starting with the business entities. Since part two is all about the corporate and the partnership and the business taxation. So we will first understand the business entities today. It's 6th October. Also along with this, we'll complete the business taxation. Some disclaimer I would like to give is this is just a revision lecture. So please, those who have already attended the regular session, or those who are already studying and have completed their regular studies, for them only this lectures will be useful. Okay, so we are going to complete today business entities, business taxation. Then for business properties, we are going to take it whole on a single day. Okay, so third day will be business properties. Since Sunday is coming in our sessions, so on Sunday we'll complete whole partnership and whole corporation. So make sure you don't miss the Sunday's lecture. Today we'll have, on Friday we'll have one lecture, then directly we'll have on Sunday partnership and corporation chapter, then on Monday we'll have business property. Okay, and then on Tuesday and Wednesday we'll take the remaining two topics, that is retirement plan and specialized return. So on the last day only, previously yesterday, our part one revision batch was completed and it hopefully completed within time. So for part two, I'm estimating minimum 4 to 5 days. Okay, so how many of you are having exams in October? I know few people have joined. Some might not be aware about the part two live revision, but no worries. How many of you are appearing in October? Anyone? In December? In Jan or maybe Feb? Anyone? Like, are you guys going to appear in the upcoming window? No? So I just wanted to know that, because all these lectures are based on 2022 tax law. If you are sitting here with the next year's window, then you will not be helpful. This lectures will not be helpful. Okay, so without wasting any time, let's start with our first unit, that is business taxation. Business entities. Okay, for business entities, first everyone is aware about the basic criteria about what are the different types of business entities. One is sole proprietor, second is partnership, third is qualified joint venture, then we have corporation, then we have LLC. Okay, LLC, and then we have trust and estate. Okay, these two topics will be covered in a specialized return. When we do the specialized return topic, at that time we will cover the trust and estate topic. So what do you mean by sole proprietor? It's simply an unincorporated business which is owned by one individual. Only a single person as a owner is there. The owner will be personally liable. Owner will be owner of a Schedule C. Okay, so means if a person is just a single owner, he is not going to file any business tax return. He is not going to file any 1065 or 1120S or 1120, but it is going to be shown on directly Schedule C of a 1040 return of his individual 1040 return. Okay, second is a partnership. Partnership is something which is we commonly call as two or more persons join together and start a new business, right? They come into a partnership, that is known as partnership. Now in US taxation we have bifurcated. We have seen that, already studied that the partnership will be of two categories. One is general partnership, right, and second is the other than general partnership, okay, limited partnership, where one will be the general partner. Okay, general partner means who will be wholly and solely personally liable for the debt. So general partner is a one person who is personally liable for the debt. Partner can be individual, corporation, trust, estate, or any other person can be a partner into partnership form. But if I talk about S corporation, there you will see that if a person is a foreign individual, they cannot be a partner into a S corporation. They cannot be a shareholder into the S corporation. Okay, so partner is anyone who is individual. Corporation can also be a partner, trust, estate, or a partnership form. Taxes are not paid by the partnership. That is why it is called as a pass-through entities. All the taxes will be paid by the partners in the form of Schedule K1. I hope everyone have gone through these regular topics already. Okay, and which reporting form we are going to use is 1065 will be used for the partnership form. Okay, next is qualified joint venture. What do you mean by qualified joint venture? An unincorporated business. Guys, I am audible properly, right? Hello, am I audible properly? Okay. So what do you mean by qualified joint venture? An unincorporated business which is jointly owned by the married couple. Okay, if a husband and wife are running a business together, right, they will be called as a qualified joint venture. Now they have an option, like for the purpose of tax filing, either they can select themselves as a partnership firm, or they can include themselves as a separate individuals and include their particular share of income in the Schedule C. Okay, so let's read what it is. Qualified joint venture means only the member are the married couple. By default, it will be treated as a partnership for federal tax purpose. Now, if you don't want to treat yourself as a partnership firm, right? If you don't want to get into those legalities, both the husband and wife, Mohit, I think there can be some technical issues, like some internet issues from your side. Everyone is able to see the screen properly, right? There can be some internet issues from your side. That's why the screen might be blurred. Okay, no worries. Joint qualified joint venture, both the husband and wife should be married and should be into running into the business. If they do not opt anything, they will be by default called as a partnership firm. Okay, now both the spouse can elect out. They can elect out of not treating the business as a partnership, because they can put it into their individual tax return in the form of Schedule C on the respective returns. The condition is, you have to remember this condition, it is important. One condition is they should be married, they should file a joint return. Second condition is both should be materially participating in the business, and business should be co-owned. Both should be materially participate, both should involve equally into the business, in doing the business. Okay, got it? This is about qualified joint venture. Next is corporation, a person or a group who is going to incorporate by a character from Secretary of State. Okay, if you are going to recognize your organization in front of Secretary of State, okay, that is called as corporation. C corporation will pay taxes by themselves. Unlike the partnership firm, the taxes are going to be passed through to the partners. Same way for the corporation, there is no pass through. All the taxes will be paid by the C corporation themselves. So C corporation will pay the taxes, and then again it will be paid by the shareholders when they receive the dividend, right? So if they receive the income in the form of dividend, they will show it as an income in the 1040 form. Okay, S corporation. Now in case of S corporation, it is a pass through entity, and that is the reason why it will be compared similar way. The same way will be used as we used for the partnership. Okay, now limited liability company is not recognized at the federal level. Now it is a duty of the organization to file either 2553, right, to incorporate themselves as a S corporation in front of IRS as a federal level, at a federal level. LLC is something which is incorporated at a state level, and here article of organization is filed. What is filed in case of corporation? Article of incorporation is filed, okay, to the Secretary of State. Same way over here, article of organization is filed to incorporate a LLC. Now, LLC members will not be personally liable. Here, as you see in the partnership firm, we have a general partner and we have a limited partner. General partner is someone who will be personally liable. Even for the payment of debt, if the partnership firm is not able to repay that, the general partner will be personally liable for all those debt. Okay, and but in case of LLC, all the members are not personally liable. For federal income tax purpose, they can either elect as a single member LLC. If it's a single member LLC, it will be treated as a sole proprietor. If it's a multi-member LLC, it will be treated as a partnership and can be elected to be classified as a corporation. If it's a, see, by default classification is what? If it's a single member, it will be disregarded sole proprietor. If it's a multi-member, 2 or more persons are there, it will be by default treated as a partnership. Now it is your duty to mention the IRS that, look IRS, I don't want my organization to be treated as a partnership but as a corporation. Then you have to file a separate form to mention that I want to go for S Corp election or C Corp election. Okay, next type of entities we have seen, like in regular classes, trust and estate. Trust is something when you are alive. Okay, when you're alive, you have created a trust where all your assets are being added to that particular trust. Okay, so can be treated, can be created while alive or upon death, which is a separate legal entity. Okay, estate is something which is created only at the time of death. Once a person dies, I will request you guys to go through the part 1 last day topic, that is whole topic is related to estate and gift tax. Okay, you can just go through that once if you want to revise it today only then. Okay, so on death of individual, a separate legal entity is formed, that is estate. When you are alive, all the assets are being transferred to a particular fund, that is a trust. Okay, so this was all about the business entity, basic overview of business entity. Now let's see in case of LLC, how the tax treatment will be made. The default treatment, we have seen that LLC which is having 2 or more members will be classified as a partnership. LLC with only 1 member will be called as a disregarded and will be called as a sole proprietor, will be reported on Schedule C. Okay, what is alternate election, guys? If you do not want yourself to be treated like this, you can go for alternate election by selecting a checkbox regulation section 7701. Okay, elect the alternative treatment up to 75 days from the beginning of the year. There can be one MCQ based on this calculation, that from the beginning of the year, means from 1st of Jan, you have 75 days, right, to elect yourself either as a S corp, either as a C corp, either partnership or any other entity which you want to elect. Okay, apart from default treatment. So what are the form which you can go for? 8832 will be used for treating yourself as a corporation. 2553 will be used for treating yourself as a S corporation. For treating yourself as a partnership, you don't have to file a separate form, because it is already a default election. You don't have to make it a separate I can say filing for that particular purpose. Once elected, that cannot be changed for 60 months. Okay, it cannot be changed for 60 months. You have the option for within 75 days, you can file and decide what treatment you need. Okay, got it, guys? Next is employees. Now, what are the employees? This definition is most important, because there will be one MCQ based on the payroll taxes, like in what situation the payroll taxes will be deducted. If a person is an employee, then only payroll taxes will be deducted. Common law employee. If a person is a statutory employee, there are certain categories, there are certain conditions. If you fulfill them, then only the taxes are deducted. Only what kind of taxes will be deducted, we'll see over here. Okay, if all conditions are met then. So what are the types of employees? First is independent contractor, second is common law employee, third is statutory employee, and fourth is statutory non-employee. First one is independent contractor. They are not an employee. They work for other people also. They provide services to other organization also, right? So that is called as independent contractor. Okay, subject to self-employment tax. They are not liable for the payroll taxes, but they will go for the self-employment taxes. What is self-employment taxes? 15.3%, which is nothing but your 6.2%, all your payroll taxes rate is there. Exactly take the total of your payroll tax and make it as a self-employment tax. Okay, so this is not an employee. So that's why they will be liable for self-employment tax, not payroll taxes. They offer service to general public. Okay, they will offer services to the normal public, not for an individual employer. Person for whom the services are performed, they have the right to control only the result, not the way how the work is performed. Okay, being an employee, just think as you are an employee working at one organization, the end result is also controlled by the employer. The way how you are going to perform is also controlled by the employer. Okay, all the ways, all the means, all the investments, everything is of employer. You are just working over there at the condition of the employer, right? You don't have the right to control the way the work is performed. But in independent contractor, only the result will matter for the person who has assigned the work, not the way how you are going to perform. It's all your thing. Okay, common law employee is something which we call as normal employee in Indian language. Normal employee-employer relation, where employee is the person who is going to perform the services, right? And the person for whom we are providing services, means I can say employer has the right to control how it is done, what to be done and how it is done, and also the result will be controlled by the employer. So remember this line is most important. This line will segregate the common law employee from independent contractor and statutory non-employee. Okay, so there will be confusion little bit between these three, but please don't get confused, because this is the line which you can just remember, that the result should be controlled by employer if it's a common law employee. Result plus how the work is done, both the things will be controlled by the employer. Okay, employee can be full-time, part-time, both will be called as a common law employee. Officer who does not receive any pay and does not provide services, or who provide minor services, not considered as an employee. Okay, so officers who are just providing some management related service, admin related service, or some administrative services, and who is not going to receive any pay, okay, just a subsidiary services if he is providing, then he will not be called as an employee, he is just an officer. Okay, third one is, last one is, employer will withhold and pay the federal income tax, social security, Medicare. So all the payroll related tax will be liable to be withheld in case of common law employee. In case of independent contractor, no withholding will be done. There won't be any withholding of taxes which will be done by the person who is going to pay, right? But instead they are going to receive a 1099 NEC. Here they are going to receive a W2. Right? Statutory employee. What do you mean by statutory employee? Here specifically W2 box 13 will be used for a statutory employee. You know, if you have seen the W2 form, there are 3 boxes over there. Either the employee is covered by the retirement plan, either the employee is statutory employee, statutory non-employee, all those, these 3 boxes are there. Over there you have to check box that the employee is a statutory employee. So in this case, whoever is providing services to a employer, and if that employee is a statutory employee, who will be statutory employee? Those who fulfill the 4 categories. Along with this, those who fulfill all the conditions, if they fall in any of these 4 categories, okay, and along with that, if they fulfill all the 3 conditions, 4 categories and 3 conditions, you have to remember. Okay, if they fulfill this, they will be called a statutory employee, and if they are a statutory employee, W2 box 13 will be checked mark as a statutory employee, and once it is checked marks, it will not be shown on your 1040 line 1 as a wages, but it will be shown as an as a income, business income. Okay, but there will be some withholding of taxes. Okay, withholding of social security and Medicare will be done. Federal income tax will not be withheld, only social security and Medicare will be withheld in that case. Got it, guys? So what are the 4 categories? Let's quickly understand. Driver who distribute the beverages. Just take the example of Uber driver who is also distributing the beverages from one place to another. Okay, we have that facility. Uber Eats is there, right? So the beverages are being distributed from one location to another, but here there are some exceptions. You can just refer the regular book, in that it is mentioned, except milk. Okay, except milk, other all beverages will be considered in this category. Okay, second is, if a person is a full-time life insurance sales agent. Life insurance sales is just selling the sales life insurance policy to different people, okay, different customers, different clients, but he is working for only one employer, right? So that is the one situation. Third one is individual who works from home on material provided by the employer, plus work specifications are also provided. Okay, so let's say if a person is working from home, plus material is also provided by the employer, and work specifications are also provided by the employer. Got it? And the last one is full-time traveling city sales agent. A person is selling some goods by going from door to door, right? A city sales agent. So any one of the person who is falling in any of this category, right? Along with that, if they fulfills all the conditions, what are the conditions? All services are to be performed personally. They are going to perform it personally. They are not going to assign the work to someone else. They do not have substantial investment. Say insurance sales agent is not having any investment of his own. Even though he is working at a flexible timings, he is working as per his own pace, but whole investment is of the insurance company, right, in everything. So they should be performing the services personally. They should not have any substantial investment in performing the services. And third, that has to be performed on continuous basis. So insurance agent is going to work on daily basis, right? So here you will get confused that, can I say the insurance agent is an employee of the office or organization of the insurance company? No, because he is falling under this 4 category, plus if he fulfills all the 3 categories, he will be called as a statutory employee. If he is a statutory employee, only 2 taxes will be withheld, that is social security and Medicare taxes. Okay, and the last one is statutory non-employees. Think like you are a wholesale trader, right? If you are a wholesale trader, then it's a statutory non-employee. Self-employed for the federal tax purpose. Direct seller, if you're a licensed real estate agent, right? Direct seller, or if you're retailer or you are selling the goods and services directly to the general public. I know independent contractor and non-employee, there may be some confusion. I'll give you one example. Independent contractor, let's say there is one worker who is into the construction business. Okay, now he is working for AN company, he is giving services to BN company, he is giving service to CN company. So he is an independent contractor who is giving service to three different companies, three different sites. Okay, statutory non-employees, what? Think like you are selling the materials of the construction for doing the construction business. So you are a direct seller or you are a licensed real estate agent. All the payments are related to sales or other outputs rather than the number of hours worked. Based on number of hours you are not going to receive, you are going to receive it on the number of units you are selling. So that is a trading or retail business. Okay, services are performed under a written contract that provides they will not be traded as an employee for federal tax purpose. So this word is important to remember. This line is important, that there is a written agreement that they are not an employee of this person. Okay, last one is companion sitter, who are not the employee of the company, but they are just providing the placement services. Got it, guys? They are just providing you the placement services, that is known as companion sitter. Next is taxes, withholding and reporting. See, before moving to the next slide, I'll just repeat once more the disclaimer. Those who are watching this lecture, these are just a revision lecture and it will be a quick revision. I'm not going to explain anything in detail. For attending it on a regular basis in detailed manner, please go through our regular sessions. Okay, but for this there will be just a rapid revision. I'm not going to explain any examples or anything. Okay, tax withholding and reporting. Self-employment taxes, what are these withholding which you are going to do? First is self-employment taxes. Self-employment taxes is, can be bifurcated as a social security, Medicare, right? Primarily for the individuals who work themselves. Means, can I say independent contractor, they work for themselves, they will be liable to pay self-employment taxes. Okay, this is nothing but the same percentage will be used as it is there in the payroll taxes. Self-employment tax is nothing but a social security and Medicare tax primarily which is paid for individuals who work for themselves. Okay, income which is earned as an employee or as a notary is not subject to Self-Employment Contribution Act. The reason is they will be liable for the payroll taxes. Okay, so the payment of the Self-Employment Contribution Act tax contribute to coverage under the social security system. So SS social security system is a whole system which will give you the laws and regulations regarding if you are a self-employed, how you are going to treat it. But for exam purpose, just remember in a very short manner, I'll just explain. You have to just remember that the percentage is 15.3%, which is 6.2 social security, 1.45 Medicare. Why I'm saying the 6.2 50% was for employer, 50% was for employee, and that is why when you do the total it is 15.3, but it is unfair to treat the whole 15.3%. That is why IRS mentions that out of the total self-employment taxes which you have paid, you will get a 50% as an adjustment. Okay, you will get a 50% as an adjustment to your income. Okay, so here the social security taxes are 6.2%, 6.2, that is 12.4% on first 1,47,000. Over and above that, even if your income goes, this is the earnings. Okay, even if your earning goes higher than this, you have to deduct maximum on 1,47,000 only. Same way for the additional Medicare, apart from 12.4, we have 2.9. Apart from this two, we have additional Medicare of 0.9%. Okay, so if your income is more than 2,50,000 in case of MFJ, for MFS it is 1,25,000, and for single HOH and qualifying surviving spouse, if it is more than 2 lakh, then you are going to charge an additional Medicare also, that is 0.9%. This self-employment tax is specifically related to Schedule C, guys, not for 1120S or 1065 or 1120C Corp. It is specifically related to Schedule C. Okay, next is See here, you can see if a person is having net earnings of more than 400, they will have to pay self-employment tax, and self-employment, schedule SE, you will have to file. Schedule SE, you will need to file along with your tax return. This is there in already in the 1040 return, but for the business tax purpose, it is important to understand that where a person is doing a business as a sole proprietor, they will have to pay the self-employment taxes. There is one example. Peter has $1 lakh income from a self-employment. If Peter were an employee, okay, his employer would have deducted 7650, right? How 7650? 7.65% means 6.2 plus 1.45, 7.65% he might have deducted his employer. So what he will do is subtract his portion from his self-employment income to determine his net earning from the self-employment. So when you calculate the self-employment taxes, you have to do the reverse calculation. So this is his 1 lakh is the net earning. First reduce the employer's part, which, let's say if he would have employed, how much the employer might have deducted? It is 7650. So whatever is the remaining 92,350, on this directly apply 15.3%. This is how the self-employment tax calculation will be done. Okay, and accordingly it will be 14,129.55. Okay, got it, guys? So this is how you are going to take the calculation of self-employment taxes. First deduct the employer's portion, okay, and then whatever is the remaining, multiply straight away by 15.3. Next is payroll taxes. Payroll taxes, we have three different type of taxes. One is federal income tax, where employer is going to withhold the federal income tax from the wages. Just like in India we have TDS, same way it is there. Federal income tax will be deducted by the employer based on the future earnings, okay, based on the slab rates. That is why the employer will receive a W4 form to figure out how much federal income tax he needs to withhold, right? Same way in India, we do some declarations to our employer that these are our investments, and based on that they will revise the TDS rates. Same way, FICA. FICA is what? Federal Insurance Contribution Act, where they are going to deduct, your employer is going to deduct either a social security or a Medicare tax. Okay. So social security is simply 6.2%, Medicare is 1.45%. So whatever percentage we saw in the self-employment, it's the same percentage. But remember one thing, the 50% is the expense of employer and 50% is the expense of employee. So when employee is going to receive the salary on hand, the net earnings will be received after deducting the 50% of this taxes. Payroll taxes will be deducted. Okay, and additional Medicare will be applicable over here also 0.9% if your earnings are more than a certain amount, that is 2 lakh 50, 1 lakh 25 and 2 lakh in case of MFJ, MFS and single HOH or QSS. Okay, you have to report all these taxes on your form 941 or a 944. Okay, this is specifically for agriculture, some small taxpayers. So these are some full forms which are mentioned over here. So we already know about the full forms. Federal Income Tax, FICA is Federal Insurance Contribution Act, and FUTA is Unemployment Tax Act. I have explained you the reason and the logic of FUTA taxes in regular class already. Why the FUTA taxes are being collected and where it will be used by the government. Okay, so from employer. Okay, from employer's own fund, 100% it will be paid by the employer out of their pocket. Employer will not withhold it from the employee wages. Means employee, when they receive the net earning, only two things will be deducted from their wages, that is Social Security, Medicare or additional Medicare. Okay, if the wages paid are more than 1500 or more than one employee is there for any part of the day in 20 or more weeks. Okay, so previous year 20 or more weeks you have to calculate, and if you have more than one employee plus more than 1500 wages are paid, then you will have to pay a FUTA taxes, who the employer will pay whole 100% of taxes. Okay, use form 940 for paying the taxes and reporting it, and 940 will be reported annually. Okay, 941 here, 941 will be used. It will be reported on quarterly basis. Okay, next is employer also need to pay state unemployment taxes. Just like at the federal level they are paying the FUTA, same way at the state level they are also going to pay the unemployment taxes in the name of SUTA taxes. Each state have a different percentage for the state unemployment taxes with a different names, like employee training program or something. Different names will be there in each and every state. In your exam they won't be asking more about the SUTA taxes. Just remember, FUTA is 100% paid by the employer. Remember this criteria: 1500, more than 1500 wages is paid, or more than one employee, for any part of the day is hired in previous 20 weeks. Okay. Next is taxes for family members as an employee. See, from here there can be one question. See, let's say if a child is employed by the parents, it might happen the employee, the parent are running a big business and the child is hired as an employee in their business. So if the child's age is less than 18, then there will be no withholding of the payroll tax. There won't be any social security, Medicare which will be withheld. Okay, trade or business is a sole proprietor or a partnership where the partner should only be the parents, not anyone else. But only one taxes will be withheld, that is federal income tax. Okay, got it guys? If the child is less than 18. If a child is up to 21, then no FUTA is applicable. Federal income tax is applicable. See, if you can just bifurcate it like this, if a child is less than 18, only federal income tax will be applicable. If a child is more than 18 and up to 21, right, then in that case federal income tax is applicable, right, and apart from that nothing is applicable. But if a child is more than 21, federal income tax is applicable and FUTA is applicable. Here FICA is also applicable. Okay, I forgot to explain that. So remember this way, if a child's age is up to 18, no social security, Medicare will be liable, only federal income tax will be taxed. If federal will be taxable, federal will be withheld at any age. Whenever you are earning, federal income tax will be withheld. Okay. If a child's age is more than 18, means social security, Medicare will be deducted. Along with that, federal income tax will be deducted. Only one tax that will not be deducted is FUTA taxes if the child's age is up to 21. If the child is more than 21 years of age, then all the taxes will be deducted that we normally deduct for other employees. Okay, this is just regarding the age criteria. The child's age should be up to 18, then only federal income tax is deductible. Child age is up to 21, more than 18, then federal plus social security plus Medicare. Right? If the child's age is more than 21, then all the taxes will be deducted. Okay. If parent is employed by the child, vice versa case can happen, right? Then federal income tax, FICA is applicable. Only and only FUTA will not apply. Only the FUTA will not apply. Rest all taxes will be applicable as it is. Okay, here one exception is given, that if a child is employed by the parent, the exception is corporation, even if is controlled by child's parent. See, if it's a corporation, even if it is controlled by the child's parent, then also this case will be applicable. Partnership, if each partner is not the partner of the child, then also this case will be applicable. Then also this first one, see, less than 18 years age, for this there is an exception. If it's a corporation and if it is controlled by the child's parents, then only federal income tax will be taxable, will be withheld. I know I'm going a little bit fast, but since I mentioned this is a rapid revision, if you feel that you want to revisit this topic, anyways, this all lectures are going to be uploaded on the YouTube, right? So you can revisit over there again and again, read these lectures, go through these lectures later on. Okay. Partnership, if each partner is not a partner, not a parent of the child, then also it will be fine, but only in that case age should be less than 18, and what is the situation? Federal income tax will only be deducted. Estate, even if estate of a deceased parent. Okay, if a person is working for an estate and that estate is of the deceased parent, okay, then in that case. Now this third situation, in case of family members, it can be one spouse is employed by the another spouse, right? Husband is hiring a spouse to work in his business. So in that case, all the taxes will be applicable, only the FUTA will not be applicable. The exception is corporation, even if it is controlled by the individual spouse, then also it is fine. Partnership, even if the individual spouse is a partner. Got it, guys? Based on this, there can be one question, and the typical difficult thing which people find is regarding if the child is employed with the parent, then what will be the situation. So please draw a timeline based on the age limit. If age is less than 18, between 18 to 21, and more than 21, what will be the cases? Okay, parent is employed by the child, simply it is FUTA will not be applicable, but all other taxes will be applicable. Same way, one spouse is hired with the some other spouse, only FUTA will not be applicable, rest all the taxes will be applicable as it is. Okay, next is estimated taxes. Sole proprietor, partners, S corporation, shareholders, for them, when they expect to owe 1,000 or more, they will have to pay estimated taxes. Okay, what form they are going to use? See, because partners and sole proprietor, in case of partner, sole proprietor and S corporation, they are going to pay the taxes through 1040. So they will pay the estimated taxes and show it as a 1040 ES, estimated tax voucher will be mentioned on your 1040 form, that this much taxes you have paid. Okay, next is corporation. Corporation will have to make the estimated tax payment online via EFTPS or through form 1120W. So when you file 1120C corporation form, there is a W form which you can file along with it as an estimated taxes payment information, if they are expecting to owe at least 500 or more. For individual, the limit is $1,000. For a corporation, it is $500 or more. Now, when you are going to pay is on every quarter. Okay, installment payment for corporation are due by 15th day at the end of the each quarter till 15th day of 4th, 6th, 9th and 12th. Okay, so first quarter ends on March. So next month is what? April. So 15th of April, then 15th of June, 15th of September and 15th of December you have to pay. The corporation will have to pay the taxes. The due date is different for individuals. See, for individuals, all the first three due dates are same, but the last one is of the January, 15th of January. Last installment they can pay is 15th January, but for corporation, the last installment they have to pay it on the 15th of December. I know the quarter is not ended, but still you have to pay it on 15th December. Based on this, there can be one question. Okay, so please remember the due dates of estimated tax payment 4th, 6th, 9th and 12th. Electronic deposit or employment taxes. Generally, the electronic fund transfer are made using electronic federal tax payment system. This is the full form of EFTPS. A taxpayer who does not want to use EFTPS, they can arrange some authorized financial institution, make them deposit in their behalf and file the 941. One example I'll give you is ADP, Paychecks. Those are the financial institutions, authorized institutions who are going to deposit the payroll taxes on behalf of the taxpayer. Right, the penalty for failure to use EFTPS is 10%. They will have to make a EFTPS payment. If they do not make the payroll taxes through EFTPS payment, they will liable for a penalty of 10%. Now, what is the monthly deposit and semi-weekly deposit? If you are having see, if the tax liability, the whole tax liability during the period is 50,000, then you'll have to make a monthly deposit. But if it is more than 50,000, then you will have to make it semi-weekly deposit schedule. Got it, guys? Semi-weekly means every week you have to make a deposit of the payroll taxes. As in when you run the payroll, semi-weekly, bi-weekly, weekly payroll is run. Always remember to deposit your taxes to the IRS through EFTPS, the payroll taxes till till the middle of the week of the next week. Okay, whenever you run the payroll next week, whenever there is a middle of the week, just deposit the payroll taxes. That is what it is saying. There won't be any question based on the time limit and this for the payroll deposition, but these dates you have to remember. Okay, mainly segregate between December and January. 15 Jan will be used in case of 1040, 15 December, the last quarter of the estimated tax will be used for the corporations. Okay, next is trust fund recovery penalty. So whenever a payroll taxes are being deposited with the employer, can I say, see, payroll has been paid to the employee, employer has deducted the taxes and kept it in his pocket. Right now, in the next month or maybe next week, he is going to deposit the whole tax, payroll tax to the IRS. So can I say till the time where he's keeping this payroll taxes in his pocket, he will be called as a trust for a now. Okay, so if he keeps any amount but he does not deposit it on time, or there is a delay in depositing it, then there will be a trust fund recovery. He is keeping all the payroll taxes with him, is not depositing it on time, then he will be liable for trust fund recovery. Same way like payroll taxes, any other withholding is done. Let's say any federal income tax withholding, social security, Medicare, any other withholding is done by the employer or any other person which he needs to deposit it to the IRS, and if it doesn't deposit it, then he will be liable for the trust fund recovery penalty. Okay, so a person responsible for withholding, accounting, depositing or paying a specified tax, including NRA withholding, non-resident also, or any employment related taxes, and willfully fail to do so, can be held personally liable for the penalty, which will be equal to full amount of unpaid. So whatever is the amount which he kept in his pocket, whole 100% penalty will be applicable. Plus, if they are not paying it on time, they are going to also levy a interest. Okay, you don't have to remember what is the interest rate and anything. Just remember that this is what called as trust fund recovery penalty. A person responsible will have to deposit it to the IRS. Who will be responsible? The officer of the corporation, or a partner, or a sole proprietor, or an employee of a firm, of any form of business. Okay, they can assign one person as a responsible person for the trust recovery penalty. Okay, got it, guys? So willfully in this case means voluntarily, consciously, and intentionally if they are not reporting it to the IRS. What are the required forms? Employers are required to collect Form I-9 and Form W-4. Okay, Form I-9 will be collected where an employer is going to verify that each new employee who are hired at that organization is legally eligible to work in US. For those employees, they will collect Form I-9. Taxpayer must complete the US Citizen and Immigration Service Form I-9, that is Employment Eligibility Verification and Maintenance Program. Okay. Next is Form W-4 is something which an employer is going to collect at the time of employee is joining. He'll just give his declaration, he'll just give what filing status is going to use. So based on that, the additional Medicare and Medicare taxes. For additional Medicare, we have that, right? If you're filing MFJ, if you're filing MFS, single, the different I can say criterias are used, 2 lakh 50, 1 lakh 25, or 2 lakh. That all things will be declared on Form W-4. What is the filing status? What is the upcoming income? Is there any other employer from where he is earning? So all declaration will be done on the Form W-4. And Form I-9 is for the eligibility check, whether the employee is eligible to work with that employer or not. Got it, guys? So I hope the first was the very basic chapter. Let's move to the next chapter. See, this I'm not going to explain you. This you already know, the informational return. This is just the list of the forms. You don't have to remember the form name, but it is just for your information we have mentioned over here. Okay, so yeah, so and these are the due dates, like which form needs to be filed by what date and up to what amount you need to check. That if it's up to 600 or more than 600, let's say 1098 form is there, then you have to deposit it to the IRS, right, till this date, and to the recipient who is going to receive it, to the payer. In case of mortgage, it will be the payer, right, till 31st of Jan. Everywhere it will be 31st of Jan. In some point there will be some other dates. You can just remember those date, all else this will basically come in part 3. Actually, you don't have to remember all the dates of reporting forms. Okay, so this is just for your information. All the informational returns we have mentioned, till what amount you need to file, and what is the due date of filing the informational return. Okay, you can just go through it once later on. Let's move to our next chapter. I think it is, yeah, here there are one more topic which is left, which is accounting period and methods. For accounting period, you have to make sure whether you are going to use fiscal year and calendar year, or a 50 to 53 week year. A fiscal year is nothing but a 12 consecutive years which is ending on the last day of the month, except December. Other than December, whatever month the financial year is ending, that is called as fiscal year. But exactly if it is ending on 31st December, it is your calendar year. Partnership, S corporation, or PSC may adopt a fiscal year by filing this form, that is Form 1128 2553 for S corporation. It must be established to business purpose for election, or Form 8716 if they otherwise qualify to make a Section 444 election. No need to remember all the sections and everything. Just remember like that, if you are going to follow fiscal year and now you want to change your accounting method, you can file a separate form, right, for change in accounting method, and make the IRS aware about the changes. Okay, and the calendar is simply 12 consecutive month which is ending on 31st December. 50 to 53 week is simply thing that let's say every year on the last Thursday we are ending our financial year. Okay, so last a day is fixed, so whatever date this same day of the week last occur is the calendar month, or whatever date the same day of the week occurs, that is closest to the last day of the calendar month. Means, just take one example. Let's say on every year we end our accounting period on Thursday, so next year also whatever is the last Thursday we will end it over there. Okay, accounting method, we have cash method, we have accrual method, we have some special method of accounting for certain items, income and expense. And if we have a combination of cash and accrual, we will use a hybrid method. Cash method is what, whenever we are going to actually or constructively receive the amount, then in that case we will use the cash method. Accrual method is what, a corporation which is not a qualified PSC must use accrual method of accounting if average annual gross receipt for the 3 taxable year, guys please make a change over here, it's 27 million for 2022. Okay, for 3 previous taxable year, if you have an average gross receipt of 27 million or more, you are going to include a accrual method of accounting. Okay, so previous 3 years means including 2022, take 2022 plus 2021 plus 2020, take all the gross assets of all the 3 years divided by 3, make it average, and check whether this is up to 27 million or more than 27 million or not. Okay, special method of accounting for certain items of income and expense, the taxpayer may account for a long-term contracts as per percentage of completion method. Okay, they will not use cash method, they will not use accrual method. This you will see basically in the construction business. Okay, as and when the construction is completed, or let's say some project related work is there, as and when the work is completed, they will use special method of accounting for certain items of income and expense. Now combination, you can use a combination of both. Hybrid, it is mentioned, it is called as a hybrid. Generally a taxpayer can use any combination of cash, accrual and special method of accounting as long as the combination clearly reflects the income is consistent. Means if you record the income based on accrual basis, then you have to mention accrual basis for all the income which you are receiving. If you are mentioning the expenses on cash basis, then mention all the expenses on cash method. Okay, generally an accrual basis taxpayer can deduct accrued expense in the tax year when the following condition exists. So if you are following the accrual method, make sure, see there will be one question based on this, okay, that in which year that person can take this business deduction, business expense deduction, if a person is following the accrual method. All the events that determine the liability have occurred. Okay, the amount of liability can be figured out reasonable accuracy. You know exactly what is the liability which is going to be occurred for this particular expense. Let's say insurance policy premium is there. Okay, so you know exactly $500 is going to be there as a liability. This is a liability currently for paying the $500 in next 2 to 3 months. Okay, so you know the accuracy of the amount. If the amount is uncertain, let's say some court case is going on, and you are going to pay certain penalties as a court fees, court award or anything which is uncertain. So if the liability is not certain, you cannot deduct that as you cannot deduct that much amount, right, in case of accrual method as an expense. Okay, all events that determine the liability have occurred means what, the goods are dispatched. Okay, let's say you're using accrual method, you are selling certain goods, so goods are dispatched or goods are shipped, order has been placed, invoice has been raised. So all events which has occurred will determine that liability has occurred, means when you're purchasing it. Okay, that's why it's the liability now to pay the amount. Okay, next is the economic performance takes place with respect of expenses. Okay, economic performance has already taken place, means let's say you have served, you have received the services, right, with the respect of expenses. Next is following entities cannot use cash method if they are having more than $27 million in 2022. The average gross receipt you are going to check for the 3 tax year, right? If it is more than 27 million, they cannot use the cash method or any combination that includes cash method. A partnership with a corporation other than S corporation as a partner, and a partnership is having average annual gross receipt same $27 million for 22, 21, 20, this 3 tax year, then they cannot use the cash method. Okay, and third one is tax shelter, who is just there for the benefit, who is just creating the company for providing tax strategies, planning, who is saving the taxes. Okay, it's called as a tax shelter. So these 3 types of organization cannot use the cash method if their gross assets are more than $27 million. Okay, got it guys. Next is business taxation. Let's see how much we can complete today. We'll try to complete as much as possible, or else if the time is not there, then we'll take it on the next not next lecture, that is on Sunday, but we'll try to complete it today only. Let's see. Inventory. So if you have an inventory and you are having inventory and reporting the inventory, then you will have to mandatorily use inventory. In that case, accrual method you'll have to use. Okay, and not applicable to small business taxpayer. Means if you are having less than 27 million, okay, do apply the same formula. Average 3-year gross receipts. Again, please change over here, 22, 21 and 2020. Okay, so if the average 3-year gross receipts are less than 27 million, then you are going to use accrual, and you are not going to use accrual method. If it is more than 27, then you're going to use accrual method, right? Or if you are handling the inventory, you are reporting the inventory, you'll use the accrual method. What is the uniform capitalization rule, guys? All the direct and indirect costs are the part of inventory. Okay, whatever are the direct cost plus indirect cost. Basically what happens, indirect cost is going to P&L, and all direct cost, capital related expense, will go to your capitalization, right, in the balance sheet. So all direct plus indirect costs are the part of your inventory if you are going to apply a uniform capitalization rule. And this applies if you acquires for resale, if you acquire any product for resale, or produces any real or tangible personal property. Means, can I say I'm a trader, I'm just purchasing on the wholesale and I'm reselling that product, or if I am producing a whole real tangible personal property and then selling it, okay, then only it is applicable. This uniform capitalization rule is not applicable in some situation, that is small producer or reseller of a personal property. Small producer is nothing but those who fulfills less than 27 million criteria. That for them, this uniform capitalization rule will not apply. Okay, property produced for personal and non-business purpose. For non-business purpose, you're creating the property. Let's say you are creating a residential home, using it for personal purpose. For that, you are not going to use uniform capitalization rule. Research and experimental cost, okay, that all things will not be called as your you are not going to capitalize those research and expenditure cost using this uniform capitalization rule. Okay, intangible drilling and development cost, property under long-term contract, then you have timber and certain ornamental trees, then you have qualified creative expense which you are going to pay to the freelancer. Okay, cost to allocable to the natural gas, that is you are going to resell it, which is you are producing the natural gas and reselling it to some other people. Okay, property in exchange of services, like kind exchange if you do, or if you provide any service and in exchange you receive a property. Loan origination or COP using simplified production method, cost of production, where you are using a simplified production method where indirect costs are less than $2 lakh. Got it, guys? What is uniform capitalization rule? All the direct and indirect cost will be capitalized. Okay, and this will be applicable only if you are buying a product for reselling it, or any real tangible personal property for producing and reselling it. Okay, it is not applicable. Just remember these exceptions. It will not applicable to this kind of people. Small producers, property produced for personal or non-business purpose. Just remember this list. Okay. Next is what it will include and what it will not include. Means when you are capitalizing, see, this is a part of this topic only, guys. When you are capitalizing the inventory, what you are going to include, what you are going to exclude. Based on this, there will be one practical question in the exam. They'll give you a list of expenses. You have to figure out what needs to be included and what needs to be excluded from the inventory. What you're going to include it first is merchandise or stock in trade. Okay, whatever purchase cost of the material that you are going to take. Purchase material is if possession is not passed. If you have purchased the material, still the possession means the physically the property, physically, let's say I have purchased this mobile phone. Okay, now this is going to be used in my business for reselling it to the further to other customers. Okay, now still it is there with the company, with the manufacturer, but I have placed the order, I have purchased the merchandise, so it will be included in my inventory. Goods under contract of sale. Okay, I am having certain goods which is situated at my location, which is under the contract of sale. I have done a contract for selling those goods with third party. Okay, so those goods which are situated at my location and which are entered for contract for sale are included in my inventory. Goods out on consignment. Let's say I have sent certain goods out on consignment to some other person so that they can sell it further in the market. So I will include those goods also into my inventory. Okay, goods held for sale in display. Let's say some the ornaments are there, jewelries are there, those are placed on the display locations, right? That will be allowed for including in the inventory. Next is raw material, work in progress, finished goods. This all are your inventory. Supplies that become physically part of item intended for sale. Let's say for producing this mobile, I have certain screen, certain small tools which needs to be included in this mobile phone. So those small items I might be having it in my inventory. Okay, so later on it will be included in my final goods anyhow. So those all will be called as my inventory. So supplies that become physically part of item intended for sale. Sales over online platform and if payment is not received. Okay, let's say I've sold my books as a cash on delivery. So I've sent the book, right? So it has been sold, but now yet the payment is yet to be received still. So I will count it in my inventory. I'll not talk it as a sales. Once the payment is received, after that only it will be removed from an inventory. So this point is important, guys. Based on this, they can twist the question. Container returnable is included in the inventory. Let's say along with a particular product, I have sent a specific container. Now this container is returnable container. Okay, if it is like that, then the container which is returnable will be included in my goods, in my inventory. Okay, you are clear about what all inclusions you need to make, what all exclusions you are going to make. Certain merchandise where which is sold, already you have sold the goods, title is passed, right? That you are going to exclude. Goods consigned. Okay, goods consigned means you have received some consignment to sell the goods. It's not your inventory. It will be included in their inventory, because read this point, goods out on consignment. If you have sent out someone for consignment, then you're going to include in your inventory. And the person who is receiving the goods as a consignment, they will not include in their inventory, because it is already included in the person who have sent out for consignment. Okay, this is little bit confusing, guys. Please make sure you read these two things properly. Okay, these 2 points are interrelated. Please make sure that the inventory should not be included twice into two different people's tax return. Okay, goods ordered for future delivery. Let's say I have ordered a car, for example, right? But the delivery will be done in the future. I am a car dealer, for example, okay, and I have ordered from the manufacturing unit, I have ordered 5 cars and it will be delivered in future. So those 5 cars will not be included in my inventory because it is not yet delivered. So it is going to be delivered in future. So let's say after 3 months or 4 months, when those 5 cars are delivered at my showroom, those 5 cars will be included at that time, not right now. Okay, so goods which will be delivered for the future delivery. Next is certain assets. Certain assets you are not going to include in inventory. See, simply those who are your fixed asset, like land, building, equipment, notes, account receivable. These are not your inventory. Real estate held for sales by the real estate dealer. Suppliers that do not physically become the part of the items intended for sale. Let's say some tools and equipments are there. I'm just using it for fitting up small tools into this mobile phone. Okay, so what will happen? Those screwdrivers are there. So those all small tools will not be included in my inventory. That just supports the fitting of the main part. The main part which is getting involved in the main inventory, that small parts will be included as an inventory, not the other parts. Okay. Next is inventory cost will be bifurcated into 3 categories. FIFO method you can use, or a specific identification method, or you can go for a LIFO method. Okay, and LIFO method if you are going to use, you will have to file form 970 in a year where the taxpayer first uses the LIFO method. I don't have to explain this. FIFO is first in first out, as in when you purchase the inventory, right? Whenever you are going to sell it, you will consider that it has been sold from your first lot. So first in first out, last in first out, because this will help in costing your inventory. So as soon as you reach at the year end, you need to make your inventory cost, right? You have to prepare the cost of your inventory and then include it in your tax return. So to find the cost, you need to identify any method, either FIFO or a LIFO or a specific identification. Specific means what? Whatever is the actual quantity, and this is applicable in luxurious product. Let's say 5 cars I am having, all the 5 are specifically identified, right? I can make the inventory cost same as that of the cost of that inventory. But let's say I am dealing into the books. So books, I have 100 books in the stock. So 10 books have been sold, 20 books have been sold. But what about the remaining stock which I am having? How much I should charge for those remaining books? So for that, either you can go for FIFO method and LIFO method. Okay, inventory valuation is simply one thing you have to remember: opening inventory plus purchases plus production cost minus sales is your closing inventory. Everyone is aware about this formula, right? But now in this purchase price, now here the uniform capitalization rule will come. Whenever you are going to include this purchase price, you have to take all the capital, the direct, indirect, all expense. Let's say I have purchased AC. Okay, I am into the business of providing AC services. I purchased the AC and I took the installation services also from the manufacturer. So direct plus indirect, both the costs will be included in the inventory cost. That is what we called as uniform capitalization rule. And this uniform capitalization rule will apply only if your average gross receipts are more than $27 million. Got it, guys? Next is expenses and reduction. So yeah, this is the main thing which there on, based on this there will be one question. Usually people get confused on business startup cost and business organization cost. Both are not the same thing, guys. Both are totally different things, will be treated totally differently. Business startup cost is something which is incurred, paid or incurred to operate existing trade or business, plus paid before the day when you activate your business, and it will include all your analysis, advertisement, any salaries, wages, travel related expense. This all will be included, but this will not include three things, which is deductible interest. Okay, so if you have paid any mortgage loan to acquire the business loan, okay, mortgage interest if you have paid to acquire the business loan, and it will be deductible anyways on your P&L, so it will not be called as your business startup cost. Taxes, if you're paying any taxes at the starting of the business, that will not be deductible. Research and experimental, the result is uncertain, right? When you do some research and experimental costs, when you incur those costs, the result is uncertain, so those will not be included in your business startup cost. Okay, organizational cost will include direct cost of creating a corporation or a partnership. Means all legality expenses, article of organization. When you create a you are going to incur certain legal expenses to list your company, right? So those are your organization costs. So I hope you understand the difference between the business startup and organization. Organization will include all the legal related costs which is incurred for the business, and business startup costs will include all the expenses which are incurred just before the starting of the business, but apart from legal expense. Okay, article of organization, article of incorporation, those are your organizational cost. So for the creation of corporation or partnership, whatever charges you have paid will be chargeable to capital account. If you are incurring certain expense, and it will go to your capital account, it's an investment, plus amortized over life of the corporation or partnership, or has a fixed life. Okay, plus cost is incurred. Cost will exclude certain two items. This you have to remember. They will twist the question based on this. If you are a corporation and if you are issuing stock of your corporation, securities, so whatever cost you are incurring for issuing those stocks, selling the securities or partnership interest, that cost will not be included in your organization cost. Cost associated with acquiring the asset or transferring the asset to corporation. So this two, please remember this two specifically, that cost of issuing or selling the stock, or second is cost associated with acquiring the asset or transferring the asset in case of partnership. See, when you're becoming a partner, this will do again when we see the partnership topic, where you are being a partner in the partnership firm, when you're bringing some asset in the partnership firm, right? So that is a transfer of asset. For transferring that asset, if you incurred any cost, right, some legal cost, title related cost, so that you cannot call as organization cost. Same way for issuing the shares, stocks and securities, if you incur some issuing costs, right, for making your shares listed on the on the site, right, you are incurring certain costs that are not going to be included as an organization. These are purely your organization cost, means your company formation cost, right, your article of organization, article of incorporation, state filing fees, right, your LLC filing fees, all those fees will be included in the organizational cost. Now, till what date this has to be incurred? Now, this will depend either you are a corporation or a partnership. If you are a partnership, it has to be incurred before the due date of return. Deduction only if expense incurred plus accrued before December. Okay. Deduction, see, expense has to be incurred. You can pay the expense before the due date of return, but it has to be accrued before December. Remember this point. It has to be accrued before December and it has to be paid until the due date of return. For corporation, it has to be incurred and paid before 31st December. There is no time limit in paying it after 31st December. For corporation, remember this difference. Partnership, in partnership, what will happen till 31st December? You can incur the expense, but you can make the payment anytime before the due date of return. In corporation, incurring the expense plus paying the expense will both be before 31st December. Okay, how you are going to elect this business startup cost? You need to amortize it. Now, how you are going to amortize it? Let's see, there is a certain limit over here. Election is in the form 4562 is to be made in first tax year. 4562 has to be made in the first tax year in which you are filing the form. Okay, before the due date, including the extension. Let's say you are filing the extended return on, like, say 15th October, then before that you can make the election by filing form 4562. Okay, if you timely file it 6 months more, if you file the return timely, 6 months more for election will be given to you guys. Okay, what is the criteria over here? Just take, in exam there will be calculation sum. Draw this type of chart. Take all the expenses which is incurred. Okay, take all the organizational business, sum it up total, right, and up to 5,000 straight away it will be allowed as a deduction, right? If it is more than 5,000 but up to 50,000, so straight away deduct whole 5,000, and whatever is going in excess of 5,000, take a difference. It will be allowed as an amortized, it will be amortized over 180 month, starting from the month of incorporation. Let's say the company incorporated on 1st of April. Okay, so from 1st of April take till December, whatever are the month, just take, it's 9 months, so take 9 months into total cost minus 5,000, because 5,000 is anyways allowed as a straight away deduction, divide by 180 month. Okay, whatever is going over and above 50,000, so up to 5,000 you are going to deduct. So take 5,000, but here there will be phased out. This 5,000 will get phased out. Take whatever is the difference over and above 50,000. Let's say 52,000 is your total expense. So what is over and above 50,000? It is 2,000. So this 5,000 will get reduced by 2,000. 3,000 is the amount of deduction which you can take, which is allowed as a deduction. Okay, got it guys? And rest, see, let's take 52,000 and let's draw this. Up to 5,000 is allowed, but since it is going more than 50,000, you are going to reduce this extra 2,000. So 3,000 you can reduce in current month. What is the remaining is, whatever is the remaining, you have to check what amount is up to 50,000. Okay, so here whole 52,000 you cannot amortize. You can amortize only 50,000 divided by 180 up in the remaining in the month during which you incorporate, multiply that much gap from that month till December. Got it guys? If you guys are solving the MCQs, then only you will get to know about this this particular topic. Okay, about the amortization and business and organization cost, how much you're going to take it in the P&L and how much you're going to amortize it. Okay, got it guys? So for today, I'll keep the session till now over here only. From tomorrow, on Sunday, we'll continue the remaining topics on the second chapter, this business taxation, and we'll start with the partnership. Okay, so Shahid, you have joined late. We are just ending the lecture right now and we'll meet on Sunday. No worries, the recordings will anyways uploaded on the YouTube channel. So just go through the recordings. Our lecture timings are normally 9 a.m. in the morning to 10:30. So from next session, from Monday, please join on 9 a.m. For Sunday's lecture, I'll give you the time in the group. I hope everyone is added in the group. Those who is not added, please ping me on WhatsApp. Okay, the description will be there just below and the description on this video. Okay, so please, who want to join the live, DM me on the WhatsApp. I will add you in the group, and from Monday you can join live. And on Sunday you guys can attend the lecture, and the topic will be, we are going to complete this whole second chapter. Okay, and we'll start with the partnership. I know in partnership the basis, the contribution, the limits, the distribution, all these things are very confusing. So we'll do that in a very well manner, taking some examples in the class only. Okay, thank you guys, have a good day. We'll meet again on Sunday. Bye.